Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday, February 3rd, 2022. Pre-recording this Trading Places Live for just a little bit later this morning. Futures currently not very good. Facebook earnings really hurting the NASDAQ in particular. Right now, we've got Dow Jones futures down about 70 points. S&P futures are down about 43 points, close to 1%. But the NASDAQ down over 300 points, which is about 2%. So on a relative basis, NASDAQ stocks seem to want to be hit just a little bit harder at the open. We'll see what happens, of course, after the open. Anything could happen. And we do still have, a couple of hours before the market opens. So futures could change as well. Crude oil prices right now down about little over 1%, closer to $87 a barrel. We got the 10-year Treasury yield up 3 basis points to almost 1.8% again. So it does look like, we're in this environment with interest rates wanting to go higher, inflation. We're still going to see bigger numbers coming out in terms of annual core inflation rate, the CPI and the PPI. I believe we'll see them both continuing to move up. Lots of headlines we're going to have to deal with over the next few months. And quite honestly, not great earnings. I'm seeing a lot more companies come in and miss earnings. The past several quarters, it's been, almost a party around earnings time. And last couple of days, we've seen a couple of big reports come out, Apple, Microsoft helping to lead the stock market back and rebound here over the past 3 or 4 days. But I don't think that's going to be the case today. We'll see how the market deals with some of these misses. Anyway, before we get into all of that, let me just walk you through today's agenda. So we'll start off, as we always do, with the daily market recap, get into talking technically. I'll show you a chart that I've been showing earningsbeats.com members. Talked a little bit about it yesterday and really thought that we might be turning the corner in terms of maybe the rally, the short-term rally ending. So I'll show you that chart and we'll get into sentiment. This is probably the biggest chart for me that tells me we need more selling. We need sentiment to shift more bearishly in order for the market to really rally. So in sentiment, I'll go over the equity only put call ratio chart there. Then we'll get into the earnings spotlight and wrap up with the 3 you must see. So let's first, let's first move over to earningsbeats.com. For those of you that are new, if you go over to earningsbeats.com, love to have you as a member. But if you just want to, kind of see what we're all about, you can go right here to our Earnings Beats Digest newsletter, sign up. Simply requires name and email address. That's it. No credit card. You can unsubscribe at any time. Just simply type in your name, email address, hit that subscribe button. We'll get you set up. We also do free events from time to time, many free events throughout the year. And we reach out to our entire Earnings Beats Digest community for those events. That's another reason to be signed up. But the actual newsletter itself is published 3 times a week, Mondays, Wednesdays, Fridays. Normally, it's just 2 paragraphs in a chart. Very, very easy, quick read, focusing on an industry group or an individual stock. Could be relating to either an earnings report that we just had or maybe one that's coming up. And it could be showing either relative strength, relative weakness, just giving us some clues maybe about the earnings report to come. Anyway, all those charts are featured in this newsletter, and it's 3 times a week. Love to have you. No credit card. So make sure you sign up today. All right, moving on to the daily market recap. So, it seemed like any other day, right? I mean, we got the Dow Jones up 224, S&P up 42, NASDAQ up 71, mid caps flat, small caps actually went down. So you can see they got up, couldn't quite get through their 20-day moving average, started to roll over. So their relative weakness still in play. NASDAQ on a percentage basis did not do as well, even though we had a pretty big jump at the opening bell. Looked like NASDAQ might lead, and it did not. Really saw selling throughout the day. Especially on a relative basis in technology and consumer discretionary. We'll talk about that in just a few minutes. Looking at the sectors, communication services was the big winner. Of course, that was because of Google's massive earnings report the night before. So communication services did very well. Real estate, look at the next four here, though, or the next three. Real estate, utilities, and healthcare. These are all defensive groups. So all of a sudden yesterday, started seeing a turn a bit more toward defensive groups. And I'm showing you discretionary because it was the weakest group. But if I showed you the next group, that was, the next strongest group, which would have been the fifth strongest sector, that was consumer staples, another defensive group. So we had Google leading communication services, but then other than that, it was defense, real estate, utilities, healthcare, and then consumer staples that were leading the latest rally. And if you recall, that's what happened back in December when we actually saw those four groups lead over the course of a month as the S&P 500 put in that final high. So you got to be careful as rallies start to mature. A lot of times what you'll see is money rotate more into defense. And that's what we saw yesterday. And to the downside, you can see the worst performing group, and it might have been the only group. I'm not certain, but I think it was the only group. I'll pull up the sector performance, all of them in just a minute, but I think discretionary was the only one that was down yesterday. So you kind of get this flavor looking at the market like it was a pretty good day. But then when you realize that four of the five top groups were defensive, and the worst one was one of your more aggressive discretionary, it's one of those under the surface signals. It just didn't quite seem right, given Google's big numbers and following up on Apple and Microsoft, and just seemed like we got off to a good start, and then things started to fizzle. And then after the bell, of course, come out with a big miss by Facebook, and their guidance was horrific. I mean, Facebook was looking for earnings, revenues next quarter over 30 billion, and they lowered it to 27 to 29. I mean, that's a big miss going forward. So a lowering of guidance, I should say, more than the miss. Anyway, let's keep moving on here. 10-year Treasury yield. Got some economic reports out this morning. They'll be out a little bit later. Initial jobless claims, of course, by the time you hear this, they will have come out, a couple of them. But initial jobless claims expected to come in 250,000. Last week was 260,000, so we're looking for a little drop there. Q4 productivity expected to come in with a rise of 2.7%. That's notable, though, because Q3 productivity was down 5.2%. So we're looking for a reversal there. January PMI composite estimate 50.8. December factory orders. If you remember, November, we had pretty strong factory orders. They rose 1.6%. December, we're expecting to see them drop by 0.2%. And then finally, January ISM services, 60 is the estimate. December was 62. So we're looking for a little bit of a drop there. As far as the reaction in the 10-year Treasury yield, not seeing it here on this chart just yet, but as I mentioned at the top of the show, yields this morning are up about 3 basis points. We're back up close to 1.80. Still in this, what looks to me like almost a symmetrical triangle, a pennant, a flag. All of these things would tend to indicate that we're probably going to see resolution to the upside. Coming off of an uptrend, this is a continuation kind of pattern. I would expect the next move to be higher. And we do have in about another week that actually it is a week from today, the CPI report. And, just based on what I have a feeling is going to be reported, I would not want to be holding growth stocks. And I think the market, after this huge rally, we may see the top and maybe we do start to roll over heading into that next week. The other thing is we've got non-farm payrolls coming out on Friday morning, tomorrow morning. And I think we're in a situation, for the longest time, when the Fed was accommodative, I kind of feel like it was a no-lose proposition with jobs. If jobs were a little bit stronger than expected, the economy was improving, so kind of getting what the Fed wanted, as long as it didn't get crazy hot. And if you missed, you knew the Fed was, at your back. So, that was the dynamic, I think, through much of the recent secular bull market advance. But now we've kind of got things going the other way. I almost feel like it doesn't matter what jobs do. It's not going to be good news. And that's kind of the mindset you get when you start moving into a cyclical bear market. It's like, bad news is bad news and good news is bad news. And what I mean by the doesn't seem to matter. I mean, if we have stronger than expected jobs tomorrow, the Fed's already talking about, based on the economic activity and blah, 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 the inflation is out of control, or, they're not using those words, but inflation's rising. And as a result, they're going to, start raising rates. That is not accommodative. That's heading in the other direction. Eliminating the bond purchases, that's heading in the other direction. So we now have the Fed kind of as a headwind instead of a tailwind. And then if jobs come in lighter than expected, then you got rates almost certainly going to go up, at least first, in March. I mean, the Fed's basically said they're raising rates in March. So you got rates going up to fight inflation. However bad you think inflation is, I don't think it's going to be anything that lasts for very long, but that's just me. But you still got the Fed fighting inflation, whether you think there's inflation or not. And at the same time, if jobs come in lower than expected, you got slowing economic activity. That's a bad combination for stocks. And we're already seeing some of the earnings reports coming out with not so great news. So I think now's the time to be very cautious, especially after we've had this big rally off of the big January drop. I don't know if we've peaked, but I'm certainly seeing signs of that. So let's talk a little bit about signs of peaking. And so this is this is talking technically. So right here on the top of this chart, I've got the S&P 500. And if you scroll down, or if I scroll down here, you'll see technology versus the S&P 500, XLK, consumer discretionary versus the S&P 500. There's your XLY. Then we got consumer staples and utilities, both defensive groups relative to the S&P. And then down at the bottom, my favorite intermarket relationship, XLY versus XLP, discretionary versus staples. Now, this is a 20-day chart, and it's every 10 minutes. So it's a 10-minute chart that spans 20 days. Back earlier in January, you can see as the S&P 500 was going down, you can see the aggressive technology group going lower. You can see the XLY, consumer discretionary, going lower. And then you saw the defensive groups. They tend to outperform when the market's weak. And we saw that, XLP versus XLU. And then, of course, when the market's going down, we tend to see this ratio, XLY versus XLP, go down. So everything was fine. We got to the bottom, though. And the S&P 500, I was kind of watching this trend line. And back at the end of the day on the 28th, on Friday of last week, we did get that rally at the end of the day and broke that downtrend. And that last rally, I think, really got things on Friday that kind of kickstarted things for this week. And you can see the movement to the upside. However, after technology, software, semiconductors, all these companies got absolutely crushed to the downside. Outside of a little early morning strength here, relative strength on the 28th last Friday, and relative strength at the open on Monday, outside of that, technology relative to the S&P 500 has been drifting lower. So yeah, the market's going up, but it almost seems like Wall Street is using that strength to move away from technology. This is not what we want to see. Look at consumer discretionary. We had this nice little bump on Monday morning, and that's been about it. I mean, we went flat. We just kind of went along with the S&P 500. In other words, we're not getting leadership from these two key aggressive groups. And yesterday, as we made the final highs, I mean, look at discretionary. It was falling apart. It was back down near the relative low from last Friday. So from last Friday to today, yeah, we've had this nice rally on the NASDAQ and on the S&P 500. The XLY has kind of gone along for the ride. That's what this tells us. It hasn't really shown any relative strength. What little we saw back on Monday morning has evaporated. Now, technology is still higher than where it was last Thursday or Friday, but we've kind of lost strength there. So these two combined really tell me that Wall Street really isn't behind this move to the upside. We're just not seeing enough strength in some key areas. Then when you look at the consumer staples, we've been going down, but as the market appears, kept going up the last 2 days, we actually have kind of stabilized on consumer staples. We have not gone back down to a lower relative low. Look at utilities since early Wednesday morning. Yesterday, we did have a little bit of weakness, relative weakness at the open, maybe just a touch. And then look at that relative strength coming in utilities. So it's just kind of painting that picture like we need to be careful. And then finally, this XLY XLP ratio, we got up and put in like a double top here, couldn't break through. And look at the last 2 days, money rotating away from discretionary and into staples on a relative basis as the market does this, goes up. That's not what we want to see. That, in a nutshell, is what we saw throughout the month of December. That was our big picture signal that we have trouble ahead. This is the short-term signal that this rally might have peaked. That's what the difference is to me. You know, normally I would pay no attention to 1 day's worth of strength or relative strength in defensive groups. But when I'm looking for potentially a top on this rally and what I think is a cyclical bear market, 1 day can make the difference. And really, if you look at technology, it's been the last 3 days. We're just not seeing the leadership in technology that would make me feel really good about the market continuing to go higher. And keep in mind, this is with, you know, strong results coming out recently from Apple and Microsoft. You'd think that would really maybe spur some buying on those groups, in that group, and it's not. Those two kind of stand out alone. They're large cap. They're, you know, they beat their earnings. They got pretty reliable earnings, and mostly the market's just saying, okay, well, we're fine with those two, but we don't want the rest of them. It's not a good, doesn't give you a good feeling about the overall strength of the market. The other thing, and this is the bigger issue for me, and I'm going to show you how I create this chart. This is the equity only put call ratio. I show this a lot to our members, and I actually showed it, I think, yesterday in my Trading Places show over at Earnings Beats. And by the way, if you watch my show here at StockCharts on Tuesdays and Thursdays, if you go over to Earnings Beats, right here, Trading Places Live, about 8:45 in the morning on Mondays and Wednesdays. If you click on this link, you won't see it now. You'll see the replay of the latest show. So latest show, yesterday's show was here. But if you come in on Mondays and Wednesdays at about 8:45 or right before 9 o'clock, there will be a link to bring you into a room where you can also watch my show on Mondays and Wednesdays. So I do it 4 days a week, but I only do it here at StockCharts on Tuesdays and Thursdays. Anyhow, so the put call ratio, the equity only put call ratio, is a sentiment indicator that I think is really important to follow. You know, every day's number, you know, maybe it helps a little bit in the, you know, daily and short term direction of the market, but the long term is what I'm interested in. So let me show you how I set this chart up. All I did, pulled up the $ CPC. It's just my normal daily 1 year chart. So you see the 1 year, all this activity. Well, the first thing I'm going to do is go down here and let's change this to 20 years. All right. Candlesticks is fine for now. Volume, don't really need that. And then I'm going to come down here and I'm going to put in the S&P 500. And I'll put the chart height in and we'll do a solid thick line chart. All right. So now what I have is 20 years, and you can kind of see this thing. You know, this is the daily equity only put call ratio. And then we got the S&P down here on the bottom. Now, this is a lot of noise, but you know, one of the things I was saying yesterday to focus on is just kind of look at the body of this. Forget about these tails that kind of poke out from time to time, where we have like short-term surges in the equity only put call ratio to the upside. And then also occasionally we'll have to see surges to the downside. Focus where the real dark red is, kind of, you know, it'll give you a little sense of the sentiment in the market. In 2007, as we were topping, look at how the body was going up toward the upper end of this long-term range. When you start to see that, I mean, we're getting some bearishness at the top, which was interesting. But as you move down here, see how the sentiment changed, and instead of being way down, here, we had kind of moved up in this area. So the average equity only put call ratio was moving more toward 1-to-1, which is 1 put to 1 call. I mean, when you're at 0.5, you're at 1 put to 2 calls. So you're much, traders and options are much more bullish trading calls the lower these readings are. Okay. Well, right before, you can kind of see we were a little bit lower in 2007. And then we started moving up with this first move to the downside. Now that turned out to be, this was part of a much longer secular bear market. So you have to kind of understand what kind of market you're in. I don't believe we're in this kind of a market. I think we're in a cyclical bear market potentially, where we go down for a period of time. I think it could look a little bit like 2015, maybe worse in terms of a percentage drop to begin with. And that's because we went up so much after the pandemic. But just kind of look at the CPCE and how the sentiment kind of moves up and then back down. It moves down more bullish as the market keeps going up. All that fear gets rinsed out of the market. And then as we start to top, we went up for a long time, market needs a break. And then look at how the sentiment gets reset higher while we're going through all of this. And then once we reset the sentiment, the put call ratio back up higher, then we're ready to launch again. And then we start working our way down. And finally, I guess it was right at the bottom of the pandemic. You can see we had spiked all the way up here, got the fear really on an individual daily basis. We moved up into a range that we rarely saw. And that created enough panic where we could launch here. But notice here, very similar to 2012 and 2013, 2014, you see how the S&P barely had any pullbacks, and you see that down sloping sentiment. Look at this. Now, as we go up, we've had hardly any pullbacks, and look at this down sloping. Well, now I think we're into this area right here where we need, before we can launch again to the upside, we need this sentiment to move back more bearishly. And I believe it's starting. You can kind of see it already. And I think this is going to continue at least for the next few months, maybe several months, as we go through a lot of wild volatility and choppiness. I said at the beginning of the year, I thought this was going to be a crazy year. I'm on record saying that I thought there would be a minimum of a drop to 4,300 on the S&P 500. We've already seen that, but I've also said I wouldn't be surprised to see a 20% or more drop, which would be a cyclical bear market. So, and I think we're going to do it. I think we're going to need to do it. Coming off of all this strength, I think we're going to have this period of volatility, weakness, and I think we're going to reset. And once we move this back up and you start seeing more of this going on for several months, or at least a few months up into this range, maybe instead of the normal being between 0.4 and 0.6, the range moves up maybe to 0.5 and 0.7, maybe up into this area for a period of time, or better yet, 0.6 and 0.8, or maybe 0.5 and 0.8, kind of like we were up here. We need to start seeing that become more of the norm. And then I think we'll be in a position later in 2022 to make a run. All right, earnings. Wow. Well, Facebook. I wrote to members in my daily market report yesterday, and one of the bullets, I have I don't know, usually about 6, 7, 8 bullets, kind of an executive bullets at the top, just talking about some of the big things going on in the market that, or something coming up. And one of those bullets was Facebook is going to be reporting earnings after the bell. And this went out, I don't know, 2:30 yesterday or something like that. I don't remember what time I sent it out to members. But I said, Facebook's going to be reporting. And I said, it's going to be interesting for sure, because Facebook going into its earnings, it's in the internet space, just like Google, but going into earnings, it didn't look anything like Google. Let me show you the relative chart here on Facebook. Facebook back in October was at a 52-week relative low versus its internet peers. And even though it had started to strengthen a little bit, you can see the last month, Facebook has turned back down and is now closer to its 52-week low than it was its 52-week high when it reported its earnings. I want you to compare this with what Google looked like heading into its earnings. Look at Google. Look at 6, 7, 8 months of relative strength. Google, I mean, if you look at this and you're looking at internet stocks, what this is telling me is that Wall Street is putting many, many more resources into Google than it is Facebook. It believes in Google. That's what relative strength tells me. It does not believe in Facebook based on the way that Facebook relative strength has been, or relative weakness. And the difference in the reports was pretty obvious. Google comes out, they blow the numbers away, a 20-for-1 stock split, great forecast. And then Facebook is about the polar opposite. Let's go back down and look at Facebook. So Facebook been downtrending. Look at the AD line, weak. I mean, there's just not a whole lot. You know, internet stocks had been very weak. That's the other thing, is even though we were showing a little bit of relative strength for a couple of months, the overall group was horrible. So if you look at, Facebook relative to the S&P 500, we didn't see any bounce. Facebook continued to move lower, and just last week was sitting at close to a 52-week relative low to the S&P 500. This is not the same look going into earnings that we saw with Google. And that's why, to me, this is one of the most important parts of a chart going into earnings. Look at how a stock is trading versus its peers, which I think is probably the most important. But also look at how its peers are trading relative to the S&P 500. If both of those lines are going down, I would be very careful. If they're both going up, I would feel better about holding my stock and my company into earnings. Not, you might have a company that looks really good going into earnings and it still pulls back because it's a buy on rumor, sell on news kind of event. But I would feel better holding on that pullback if I did hold into earnings, because I feel like it's a company that Wall Street's endorsed. And they're the ones that send all of their MBAs out, and they do all this research and they talk to company management, and then they go back to their offices and they're buying for themselves and for their clients. And that's the only way we know what's going on, is by looking at the relative strength on the charts. So anyway, Facebook getting clobbered this morning. I mean, we could pull up real quick the down 22%, down $71 this morning. And as a result, the QQQ is down 2%. It's going to be down about $8 at the open. It was up $3 yesterday, by the way. That's how much this is going to have an impact. And here's that chart coming down. There's that Fibonacci retracement back up near the 50% area. This is a level where this prior, sell-off could start to gain strength again, back to the downside. Just be careful. Make sure you're protected, whatever that means to you. All right. 3 you must see. Got to get through this pretty quick. And there are other earnings reports out, and there were several that missed, by the way. In fact, let's just go over a couple of these earnings reports that were not particularly good and just look at their charts. MKL, this was Markel Corp. Markel missed 1571 versus 1653. It's a very light volume stock, so it's probably one that I wouldn't trade anyway, but I would expect maybe to go back and test this series of support here. Let's see, what else did we have out? LNC missed on its earnings, down 4% pre-market. It's been going sideways. Yeah, AD line started to strengthen here on this move, but overall has been down. I would look for this move back down closer to the 62 area. And then the last one I have for you, ABBV, had missed its revenue numbers. Got a negative divergence on this recent breakout. I wouldn't be surprised to see a pullback maybe to 130. All right, that's it for me. I appreciate everybody tuning in. Have a great day. Be careful out there. I'll be back on Monday of next week for your next Trading Places Live over at earningsbeats.com. Happy trading, everybody.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.